I want to make a video on essentially tight channels and breakouts of tight channels and overall tie it into breakouts and why breakouts succeed and fail. And so this is going to be a bit of a choppy video because I kind of have points written out in a general idea, but I'm not sure, I'm just going to try and explain them as best I can. So I want to start off with why, a good breakout and show examples of it. Signs of a good breakout, things like 47, 48 being the same size. That's what you want to see in a good breakout. And if the bars get too big, it often becomes parabolic. Obviously, context is important as well. You can see here, this was Monday. And if you look at Monday on the daily chart, you can see we were extremely overbought. So traders were expecting a move down overall. And when traders are expecting a move down overall, when you get the move down, it can often be pretty sharp. Additionally, the most important aspect of any breakout is trap traders. You can see, it wasn't unreasonable to buy below 46. Let's say you're a bull, right? And you have this big bull leg and you're hoping you're going to get another bull leg and a second leg up. So it's not unreasonable to buy below 46 looking for, essentially an outside up bar or some sort of bounce, or be willing to scale in lower. It's probably not the best thing in the world because you're at the top of this trading range, but it's not unreasonable to do. And then you see that. And the traders who bought below this, now you have all these bulls who bought below here are scaling in, and they're holding a losing position. And they see 47, and a lot of them will think, well, that wasn't, that's not what I wanted to see at all. But it's possible that, this ends up being a bear trap and we get a reversal up. So a lot of traders will hold, and then they see this. And now you have a big, a pair of bear bars closing near their lows. And 48 is important because it's not disappointing, right? When you get breakouts, a lot of times you get disappointing follow through. And when you get disappointing follow through, a lot of times those breakouts don't go very far. Something like, in theory, buying above 61 and then you get, 59, and then you get 60 and you're thinking, oh, well, that's not what I wanted to see. If I'm buying above 59, which isn't a very good idea, but if I'm doing it, I wanted to see a huge bull bar closing near its high. And we ended up getting, something disappointing. But when you sell 47, how are you feeling about 48? You feel great about 48. You're probably sitting there thinking, oh, well, I might make a lot of money right now. So additionally, this is a trading range, right? This overall is a trading range. And 48 closes below the low of the trading range. And when you get bars closing below the low, when you get a trading range and you get a breakout of trading range and you get a bar closing below the low of that trading range when you're getting a breakout to the downside, that's really important because it traps those traders in too, right? So you have the trap traders who are buying below here, who are buying below here, who are buying below here. And now you have trap traders who are going to buy the low of a trading range. Why? Because trading ranges generally, they generally stay trading ranges. Traders, they'll fade this breakout, they'll fade this breakout, they'll fade this breakout and keep scaling in, knowing it's probably coming back because they're thinking this is a trading range. And, and traders over here will be fading the breakout below this trading range, thinking that, well, this is a really good bull leg, so probably sideways, that worst case scenario. And it's really subtle, but you have to look and see that if you bought below this, right, you buy below 38 during 48, you never got out. You never had a chance to get out at break even. A lot of times trading ranges will be very forgiving and give you a chance to get out at break even. But every once in a while, you get all these trap traders who are now all in this trade and they're holding losing positions and they can't even get out at break even. And that's what's causing, these dumps like this. That's what's causing trades to go for a long ways is those trap traders. Additionally, with strong breakouts, you oftentimes get, you want to get 3 bars in a row. Generally, 2 is good. 47, 48 is really good, but you generally want to see more follow through. If 49 is a bull bar closing near its high, let's say 49 looks like, I don't know, a bigger version of 10 or something, or a bigger version of 15, probably not 15, but a bigger version of 10, and traders can buy low, they'll bet that this is a bear trap. So 49 being a bear bar closing near its low is really important because now you have 3 straight bear bars. So now let's talk about, this breakout. You can see, the important thing here was, first off, this was probably a minor reversal, buying above 10. It was probably minor. We might have had to get up to here, but it was most likely minor. And when that changed was bar 15. You get 15 and the bears who sold above 14, it was a reasonable sell thinking that this was a trading range. Generally, when you get it, you could argue this is a buy the close market. It's not great because the tail's on the top, but you could argue. And, the bars, look how big 13 is. It's getting parabolic. But I'll get to that. But, generally when you get a bar like 14 in a buy the close market, the doji, the buy the close market's going to end within a bar or two. And then you end up getting 15 follow through. And traders are thinking, uh-oh, well, now I'm trapped. I sold above 14 and I want to get out around break even. So they're scaling in, hoping that the breakout above this high is going to fail. And then you get 16. And what happened here? The traders who sold above 14 and who sold above 13 during 15, look, they never got out. If you sold above 13 during 15, you're now trapped and you're in a losing position. And those traders are going to have to exit at the market at some time, and they're going to cause a bounce. And that's what's happening on, this bar 17, I think. Yeah, on bar 17, that's what's happening here. That's why you get this big bar, because traders are exiting, and that's causing the market to bounce. The bears are being forced out. But it's also parabolic. So when you're looking at this, you have to be thinking of it as the concept of a tight channel. That's how I think about breakouts. Everything in the stock market is really just a channel. This is a channel. This is a more obvious channel, right? Something like this is a more obvious channel versus something like this. It really is just a channel. You can draw channel lines everywhere if you want to. And so it kind of helps me to think of everything as a channel. And when you look at tight channels, so I have an example from Thursday and Friday that I want to show. So this, let's talk about bar 19, 20, 21, 23, right? All this is just this on a higher time frame. So on like a 15-minute chart, this is going to look a lot like this. And I'll show you. So we'll go 255 on Wednesday. So on Wednesday from 255, you can see, it's not exactly the same, but you can get my point that, it turns into a tight channel. Those tight channels are breakouts on higher time frames. And when you're getting tight channels, you sometimes get parabolic moves above those tight channels. So for example, bar 1 is a parabolic, it's a breakout attempt essentially above this tight channel. And what bar 1 is trying to do is it's trying to reset the market cycle. It's trying to say, well, we had a spike, you could argue spike down here and then channel. And what's probably next is a trading range, which is what ended up happening because the market moves in cycles of spike, channel, trading range. You can see here, spike, and then a really weak channel, and then a trading range. So, bulls wanted to say spike, channel, well, we're going to reset the market cycle on one. And instead of a trading range, we're going to get another bull trend. But that's low probability. It's only like a 25% chance of that happening. And the reason is, if traders were willing to pay, you look at how aggressive, traders are buying aggressively, but they're not buying that aggressively through this channel. They're a little more interested, you can see, in buying pullbacks than they are at buying at the highs. So what are the odds that now that we're at a higher price, traders are suddenly going to want to buy at the highs? It's not impossible, but it's not all that likely. So essentially where I'm going with this is when you see breakouts above channels, it's lower probability. And if you think of everything in the market as a channel, you can see that when bars get bigger, so we use this as an example, since I just mentioned that this is just this, but this is essentially on a higher time frame, this is going to look like this, right? So that's what's happening here, right? This is the tight channel, 33 through 35. And then 36 is the breakout attempt above the tight channel. Now, for context reasons, it was better, obviously, to buy 36 than 1. Context is obviously overlying the most important thing. But the point I'm getting at is that 36, yes, it's a buy the close bar. And this is, it's good for the bulls. We have 5 straight bull bars. But 36 looks climactic because it's a breakout, essentially, attempt above a tight channel. So it's not really, as ideal as it could be. And it's the same concept, I think, with, bar 12. 10 and 11 are a breakout attempt, but it's not all that strong, really. You can see 11 is mildly disappointing. If you bought above 10, you're happy with 11. You don't mind 11. You're like, okay, that's a good bull bar, but why is there a tail on the top? And, so what are you expecting, really, if you bought above 10 or you bought the close of 11? What are you expecting on 12? Well, you're probably not expecting what you got, right? If you bought above 10 or bought the close of 11, you're probably not expecting what you got on 12. 12 was a parabolic move, and it was a stronger breakout than most traders were anticipating. And so when that happens, if you're thinking of, 10 and 11 as a channel, 12 is a breakout above the channel. And the bar is so big that it might be parabolic. So it's not bad to buy the close of 12. I'm pretty sure I did buy the close of 12. But my point was I bought the close of 12 hoping that we were going to get a lot of follow through. I wasn't expecting it. I was expecting a pullback. And you're buying high in a trading range too. But I was expecting a pullback, and that's kind of what we got. You see? So spike and then channel, right? So I thought that it was more likely, since this was a spike, I thought it was more likely we were about to enter the channel phase. So I was buying the high at 12, hoping that we continued to race up. But I knew that we were probably going to enter a channel or stay in a trading range. And if we got any sort of bear bar closing near its low, I was just going to exit. So buying above 12, it's, you can't really buy above it and then just try and hold through a deep, deep pullback. I would just buy above 12 and get out quickly if it starts to go sideways because you're at the top of a trading range. But my point being, that was an attempt by the bulls to reset the market cycle on 12. You could argue this was a spike and then traders were going to, expect some sort of channel or trading range overall. But then you get a surprise on 12, and 12 bulls are hoping to reset the market cycle and continue a big spike up. And instead, what we got was a trading range. So what about other times where traders are expecting to reset the market cycle? Essentially, a lot of what it boils down to is trying to think about when you get a surprise, right? When you see something and you say to yourself, well, I wasn't expecting that. You have to be thinking, well, is this a climactic move that is unlikely to succeed? Is it low probability? Or is this is this going to be a strong breakout? And again, a lot of what it boils down to is context. So for example, here we got a big gap down. So the gap down is probably going to get a second leg down at some point. We end up getting the wedge rally to the moving average, which is very common. And then you can see we tried to get the breakout down, but the channel was pretty tight. And then we got a big bull bar 37, but not a good buy, too big at the moving average. And then 40, a decently strong bear bar, a bit of a surprise. And so if you're a bull, right, let's say you're a bull and you bought above 37, or you're a bull, you bought the close of 38, or you're a bull who bought below 39, right? Because some traders are buying below 39, hoping that you're going to get a second leg up from 37, 38. Some traders will buy below 39. Look what happened. You got trapped. Those traders who bought below 39 were never let out at break even. And when those traders see 40, a lot of times they're thinking to themselves, well, that was a much stronger bar than I was expecting on 40. So I'm going to try and get out around this low. And they're not able to on 41. And additionally, if you're selling 40, you're selling at the moving average around the middle of the day. So it's a pretty reasonably good trade. And you're getting a lower high. So potential, trend line break, right? This is the bull trend line break, lower high, potential major trend reversal. And you get follow through on 41. That's really solid as well. There's a tail on the top, but it's really important that the tail didn't overlap with the 39 low and let bulls out. So when you get that strong follow through on 40, suddenly now you have all of these trap bulls. And, a lot of bulls will buy the bottoms of bull bars because it's usually a profitable thing to do, right? So when the market traded back to the 19 low during 33, they bought the low and they got a bounce. So traders will often, even buying down here around the bottom of this spike, it's not a good idea. This is too tight. But you can see even there were some bulls buying, that's part of what's causing 54. And the bulls who bought below, 35 here, what happened? They were never let out. You can see there's still that small open gap with the 35 low and the 46 high. So those traders were trapped and they were never let out around break even. And so the context for this to go a long ways is pretty good. Versus look down here. What happened? If you sold below 63, look at the high tail on 64. So you're selling below 63, essentially hoping to trap the bulls who sold below or who bought below 62. But they were let out. If they were quick, a lot of traders are definitely still trapped because you'd have to be really quick. But if they were quick, they could have bought below 63 and made a really quick scalp because you can see bought below 62, scaled in and made a quick scalp. Because the traders buying below here, you can see the tail of 64 overlaps by a tick with the low of 62. So the traders who bought below here, in theory, could have gotten out. And this is this is good for the bears, but look how overdone we are. We've already had a couple of legs down. So if you're selling down here, you're selling the biggest bars in, really deep in a channel. And again, you got to be thinking about it in relation to something like this, where it's a breakout attempt above a channel. It doesn't look the same, but really when you see 64, 65, you got to be thinking, this is a breakout attempt essentially below this bear channel. And this is probably the best looking breakout that we've had in this whole thing. And it's the best looking breakout we've had, but you're so deep in this channel that it's probably climactic instead of a new breakout. So the overall point being, this ends up being a lot more, it's obviously contextually dependent, but these big bars late in channels are less likely to reset the market cycle, and they're more likely to lead to sideways trading versus when you're in the tops of trading ranges or when the market is overall, I think the daily chart's important to give you a bias towards the day. So if you, start your day, I always look at the daily chart and just try to get an idea of what I think is going to happen next. And so if it starts to happen on the 5-minute, I can be quicker to get in. But something like this up here with these trap traders is more likely to lead to a measured move down, maybe a breakout below the wedge and a measured move, than something like this where we've already sold off so much and we've already had the big move down that the bears probably don't think we're going to go too much further. And again, if you're selling below, the close of 65 or below 65, how much further do you think we're really going to go? Do you think, 60% chance at least that we're going to get down here before we get up here? Probably not. So, and what makes 72 a reasonable buy? Well, any bear who's short for any reason is going to exit above 72. And that's, one of the keys with always in trading is finding where you think the other side is going to exit. And once, how you do that is you be the other side just a whole bunch of times is you be the other side. And, initially what you'll do, maybe you'll be short, right? And, you won't exit above 72 and you'll watch yourself get trapped. And then after you do that, however many times it takes you to learn, you'll eventually start to exit above 72. And then after you start to exit above 72, you'll eventually learn to start buying above 72 or buying above 73. So it just, it is eventually just doing the opposite of what you initially did, but it just takes a long time. And, another breakout that I thought was interesting. So first off, none of this was amazing to sell. Like it was fine. Like you can be short here, but it's not all that great because of this bull move. This bull move was strong spike here. You could argue 1, 2, 3. It's kind of a misshapen wedge, but too strong to be selling, I think, until, somewhere down here. But it was okay to sell, but you had to be quick to get out. Because the day was likely a trading range. Look how strong 10 and 11 is. A lot of times if you have a strong move early in the day, something like this, obviously this trumped this, but if you have a strong move early in the day, it's really unlikely that we're going to get, a huge sell-off. It's most likely that if we do sell off like we did, it's going to be a trading range. That's one of the reasons why when you got this huge bear bar closing near its low, traders just take profits. They're just going to exit. They don't think this is going to be, we're not going to get all the way down here. They think, well, this was a pretty strong move. This is a pretty strong move. We're probably going to oscillate around the open of the day until the end of the day. And that's pretty much exactly what we did. But down here, if you're selling so low in what's probably a trading range. Look at how good the bar is on 10 and 11 and on 23. So you're selling so low in a trading range if you're selling 30, 31 that you have to be really quick to get out because the chances of 30 and 31 resetting the market cycle down here are pretty low. It's probably just a third push down. You can see we had 1, 2, 3. So this is probably just a third push down. If you're selling here, you're selling right on a channel line. So the reality is you're selling really low and in an area where it's probably not going to reset the market cycle. And then you get a reversal up on 32. And if you're short for any reason, you're going to exit above 32, which is, one of the things that makes it a reasonable buy for a swing. But does 32 look like it's trying to reset the market cycle? Not really. It's a trade. It's a swing trade and you might get a good bounce, but this is a trade within a trading range. So you have to understand the difference between buying above 32, looking to get, maybe back to the open of the day, maybe back to the 16 low. But, the point, I think the more of the point of buying above 32 is you're pretty sure we're going to get back to the 29 low since it's a trading range and the traders who buy below 29 should get out at break even, which is exactly, again, the traders who sold below here were not let out at break even and they got trapped, which is what's causing this. But that's unusual. Usually the traders who buy below things and scale in are going to make money. And so something to just start noticing is, well, we had a bull bar here and those traders got trapped, but this looks like a trading range. And if it is a trading range, those traders should get let out at break even. So traders can buy above the 32 high looking to, just for a trade to get back to here, maybe get back to this low because those traders haven't been let out either. And maybe even back to the 16 low because those traders haven't been let out either. So, the point is this is more of a trade versus like looking for, a big move. Here, you're thinking, it's better, you're looking at 47, 48, you're thinking, wow, we could get a really big move down here. Versus buying above 32, you're thinking, we're probably going to get a bounce. Maybe it'll be enough for a swing, but, ultimately, is this going to be a major reversal? Probably not. It's probably a minor reversal since it's within a trading range, which is, I guess, the point I was getting at. So, this all boils down, I guess this piece of the video is the difference between major reversals and minor reversals, which is really important to understand. And generally trading ranges, in trading ranges, stuff like this is minor reversals, especially when, 30, 33, 32 not quite closing on its high. It's not quite exactly what you want, but it's enough for a bounce. That's the kind of stuff that you're expecting to be a minor reversal. So I guess my overall point here would be, when you're taking trades in trading ranges, look to buy low like you are here and look for a trade, less of a big swing. Everyone wants a big swing, but it's just probably not going to happen here. It's probably minor. And when when you get a bar like one after this, ask yourself, well, is this a breakout above a channel? Or is it something where it's good positioning or good context, and we could really get the reversal down? Versus here, you're thinking, are we really going to go that much higher? Probably not. We're probably not going that much higher there. And even over here, you look at bar 25. Think about it. This is just a tight channel, and all that 25 is doing. It's an obvious climactic breakout above a tight channel, and so it's the biggest bar deep in a bull trend. And if you look at it, if bulls were willing to buy. Think of it this way. If bulls were willing to buy here, they're buying pretty aggressively, obviously. It's a really strong trend. But when you get a bar this big, the expectation has changed because traders are trying to reset the market cycle. So when you see 25, in order for us to keep getting a bull breakout, it's really unlikely that we're going to get a bar like 25 and then we're just going to go back to this, right? We're probably not going to get a big bull bar like 25 and then just go back to like bars the size 15, 16 and keep going up. If you get a big bar like 25, what the bulls are hoping to see is another bar the size of 25 because it's trying to reset the market cycle. They want to see essentially something like we got on 47, 48. They want to see that kind of breakout and give them confidence that we're going a lot higher. But they know it's probably not going to happen because traders see this as a gift, the same way traders see this as a gift. It just looks like a parabolic breakout above a channel, so it's low probability. Kind of the same way, this is low probability because, again, this is just a tight channel. So this is just essentially what this would look like on a higher time frame. So obviously, this is stronger, but the point I'm trying to get across is that when you see these climactic bars deep in trends, they're probably not going to reset the market cycle. They're probably just going to lead to sideways trading and pullbacks versus things like this where you're selling high in trading ranges and you have, a real chance of, changing things and, creating a new breakout. So I know this video is a little choppy, but it's just kind of hard to get all my points across. But yeah, that's it.